Hi everybody, my name is Saul Miller. I am one of the portfolio managers for the Nedgroup Investments Balanced Fund. Thanks for joining me today. This is the performance of the fund since inception. It has been a tough year for us. I'll just take you through a few of the things that worked and didn't work. Offshore exposed equity did particularly well for us, as did fixed income, and that's fixed income domestically in SA and fixed income offshore. What really hurt us this year was our underweight in US equity, particularly via our derivative on the S&P 500, and we were also unfortunately late in reducing our exposure to the platinum group metal miners, so that also detracted quite meaningfully from our performance. With that, let me move on to an economic overview of some of the key regions in the world, as well as South Africa, and then I can take you through the asset allocation of the fund. So starting off with the US, economic growth in the US has been particularly strong, certainly stronger than we expected. However, we still think there are headwinds for the US economy that are building. A couple of those headwinds would include savings rates from COVID that are getting depleted. Monetary policy in the US remains tight. That hasn't hurt the economy yet, but there are usually fairly long lags in terms of that impact coming through to the economy. It's a little bit longer than it would normally be for other economies because consumers have a lot of mortgage debt, and as you probably know in the US, those mortgages are over fairly extended terms. Nonetheless, we still think at some point that tight monetary policy will bite. You've also had a lot of deficit spending from the US government. Deficits are high. They might be high for another year, but ultimately they have to be reined into a more reasonable level, which will be negative for the economy. And then unemployment rate in the US is at a trough, and usually when you are at trough unemployment, that is usually followed by a recession as unemployment rates increase. But most importantly, valuations in the US are pretty extended on a PE of about 20 currently for the S&P 500. So that's really pricing in quite a Goldilocks outlook for the US. In other words, strong growth from a already high base, as well as inflation coming completely under control. Moving on to Japan. Japan is one of the reasons where we see some positive tailwinds, both cyclically and structurally. What we've seen from the Tokyo Stock Exchange is they've introduced some reforms requiring companies to submit plans to improve their capital efficiency, which should be good for their returns on equity and will hopefully drive the prices for a number of Japanese companies to at least exceed their book values, which would also be hugely positive for the Japanese market. We've also seen wage increases as a result of COVID inflation. So we're seeing these wage increases after many decades of fairly stagnant wage growth, which could also be quite positive for the economy. Japan is one of the few developed economies that actually has positively sloped yield curves. In other words, you've got a bit of inflation and they are still keeping interest rates low, and they're keeping monetary policy quite stimulative, which should be good for the economy. And then finally, valuations in Japan are certainly in reasonable territory if we look at them relative to their long-term history. Moving on to China, things are still fairly uncertain in China. One of the key problems is obviously around consumer confidence, which continues to remain very depressed. We're seeing savings continue to grow for the Chinese consumer. Some of the key reasons for that concern from consumers obviously relates to falling property prices. That is a key source of wealth for Chinese consumers. There is still a tremendous amount of regulatory and geopolitical risk in China. We still have deflation in China, and there really hasn't been any significant stimulus. So we've seen incremental pieces of stimulus coming through over the last year, but certainly nothing significant enough to galvanize consumers into spending. So valuations in China are optically cheap. In other words, they look low relative to their own history, and they're certainly low relative to other offshore countries. However, what's difficult to determine is what a fair risk premium or a fair valuation for Chinese equity markets would be. So given all of this, we still have some exposure to China, but it is quite modest. And then finally, moving on to South Africa. As we often say, or as we've said for the last couple of years, there are still two key long-term worries for South Africa, and that really is around debt, sustainability of debt. Debt to GDP continues to grow in South Africa, and probably more importantly is the lack of growth in South Africa. Having said that, there are some short-term positives in the SA economy. One of them is obviously load shedding. Load shedding is a lot more under control versus a year ago. We've seen energy availability factors increasing quite dramatically, and we're certainly seeing a lot of provision from consumers and from corporates. Transnet is obviously key to the SA economy, and it's been particularly disappointing if we look at the move of volumes that get moved through our ports. There are some tentative signs that Transnet is improving, but I still think it is too early to tick that box in terms of it being a success. But we certainly hope that things improve there. That would be a huge benefit to our economy. In terms of key sources of uncertainty going forward, we obviously have a national election coming up this year. Although if we look at the polls, and if the polls prove to be correct, it would suggest that we probably have something in line with a continuation of the status quo in terms of SA politics post this election period. In terms of commodity prices, which are obviously important for our trade account, for our tax take, there's a bit of a worry in terms of iron ore prices being fairly extended, and there's obviously a lot of uncertainty around the platinum group metals basket, and that really relates to this uncertainty around the timing of the transition from ICE to EV. If we look at the impact of the global interest rate cycle on SA, that certainly seems to have peaked. As that comes down, that is good for EMs, it's good for countries like South Africa, as we can then reduce our interest rates. And that tends to result in a re-rating of our domestically exposed shares. So given what I've told you about SA, I think it's fair to say that we still remain in a reasonably tough economic and political environment. As a result, we think it is still important to maintain a meaningful margin of safety in our valuations when we're looking to buy SA assets. And secondly, we would prefer earnings to be driven by self-help as opposed to just general economic growth. And then finally, there are quite a number of offshore shares that are offering very decent value, and they are fairly high quality businesses. And that obviously gives us a lot of diversification away from SA exposed companies. With that, let me move on to asset allocation and hopefully explain to you why we think the Balanced Fund should be able to deliver decent inflation-beating returns in the next few years. Currently, our risk equity exposure, in other words, equity and a little bit of property, sits at about 65%. We think most regions are offering reasonable value, including SA, but the US is expensive, and hence that is where we are underweight. With that, let me start with one of the SA equity sectors that we like and where we have a reasonable position, and that would be financials, and that really talks to the very high dividend yields in SA financials. You've got shares like Absa on a dividend yield of over 10, Investec with a dividend yield of over 7.5. The reason why we like financials isn't just that the dividend yields are high, but we think those dividend yields are dependable. In other words, we think that you can get growth in those dividends. However modest that may be, there will at least be some growth in those dividends over time, which should give nice teens returns to the portfolio. In addition to that, if we do get the rate cycle moving in our favor, in other words, we do get some interest rate cuts, you could get an additional return from a re-rating of SA financial shares. If we look at some of the offshore exposed shares that are listed in SA, we have some fairly high quality companies like Anheuser-Busch and Bidcorp. Why do we like these companies aside from being high quality? Well, we think Bidcorp will not only drive earnings in future from turnover growth, but we also think there are some internal efficiencies that they can benefit from, which will further drive up their margins. The likes of Anheuser-Busch should do well just from the costs of making beer having come down quite dramatically. So in other words, you should get growth in earnings, not purely from economic growth. If we look at our offshore exposure, which is sitting around 38% currently, we're a little bit underweight equity versus where we would normally be over on average. And the reason for that is our underweight in the US market. I took you through the US market and hopefully explained our concerns in terms of headwinds to that economy, as well as most importantly, it is a very expensive market if we compare it to other markets in the world. Some of that underweight is made up by an overweight in Japan, and some of it is made up via our exposure to short duration credit in the US. So you're getting a great return in short duration credit currently. We get a yield of about 7% on our portfolio. It was a little bit over 8 towards the end of last year, but we've obviously seen rates come in. But even on a 7% yield in dollars, we think that is a very compelling real return, particularly not just compared to US equities, but it's a great return in absolute terms. Moving on to SA Industrials, where we also have a small exposure. You can see here the exposure is sitting at about 8%. And in the small and mid caps, we're actually finding great value opportunities in the 5 to 6 PE range. And an example of that would be Wilson Bailey. It's not just cheap, it's actually got a full order book, so it should also drive fairly decent earnings over the next few years. And then there's obviously high quality defensive companies like the likes of Pepkor that we have exposure to. As I said earlier, there's quite a lot of uncertainty in the mining and resource space. We're worried about iron ore prices being fairly extended. There's a lot of uncertainty in the PGM basket price, just given the uncertainty and timing of the transition from ICE to EV vehicles. However, having said that, we are finding a lot of deep value opportunities as well as some examples of self-help driven returns. So ARM is trading on a dividend yield of 10, SAPI's on about a PE on normalized earnings of 4 times, and some of SAPI's earnings are purely going to be driven by a changing of their fine coated paper mills into industrial packaging, which should be a driver of returns that at least is not dependent on the commodity cycle. And then finally, looking at bonds in SA, we are getting a fairly decent return out of bonds of about 11%, and that is a mixture of duration and floating rate notes. Given the slight compression in SA bonds from the last quarter, we would favor floating rate notes over duration at this stage, but both are delivering fairly decent returns, obviously well in excess of inflation. With that, thank you very much.